let's dive into what we're going to discuss today. I know it says butterflies and condors in the screen. That's the type of trade structure that we're going to discuss, but we'll actually cover this all in the lens of earnings because when we're utilizing options, we can use options for data analysis to understand the implied move. If you've ever heard anyone discuss that, I'll walk you through that. I've got some old examples so we can look at what happened from a trade and then look at the perspective. So that's super helpful. And then today's example that I'm going to use is Netflix. So we have the implied move. The conference call hasn't kicked off. So normally when we pull these, I want to see what happens when it opens. So we'll see what happens tomorrow. I'll leave you with that. We'll start with Netflix and discuss it. They did beat, but last time I checked, they were down a little bit. So that's what we're going to discuss today, trade structure and earnings season. So let's get started. Quick disclaimer, lots of real securities today. This is purely for demonstration purposes only, not considered a recommendation by OptionsPlay, a solicitation to offer or buy, and it's purely for educational purposes only, not tax, legal, or investment planning advice. And what we'll cover today, you guys know I love the Greeks, so I'm going to talk about the Greeks. We're going to talk about these trade structures. That way you completely understand them. So we'll go through the straddle. That's important when we discuss how to actually plot a move. That's the type of strategy that we use purely for the analysis. You can trade it. I personally don't, and I will tell you why. That's because of volatility crush. We'll talk about the long iron butterfly. We'll talk about a broken wing butterfly. We'll talk about the short iron condor. That's the famous Tom Sosnoff earnings play. We'll bring that all from an analysis perspective into a application perspective. And then, of course, I've got OptionsPlay and a couple of examples of plays that you could have done with Netflix, and then we'll see how those played out. All right, so I like to start anytime we talk about 3 or 4-legged options with discussing the Greeks. You don't have to know the Greeks inside and out to attend today's session, but it's very helpful for this reason. When we're discussing options, especially I get asked all the time, what's the one thing that I need to know, or someone who's trading options for the first time? And it is that an option adds a layer of complexity. That layer of complexity is an expiration date. You can't hold an option for forever, which means there is extrinsic value components. It's derived off of the underlying security, but now you're taking it a step further. There is implied volatility that affects the options price, which is amplified around earnings. There is an expiration date, so time affects the options price, and even interest rates. So there's so much that goes into the price of the option. And what the Greeks help us do is understand the positive and the negative factors. And the reason why I like to discuss the Greeks when we talk about 3 and 4-legged option strategies is because we layer the strategies together to amplify the positive and mitigate the negative. So, and the way that we set up the goals should make it fairly obvious, right? So if you've never seen this chart before, you're welcome to take a screenshot. I call this our most stolen slide of all of OptionsPlay, which is absolutely fine. We're here for education. If you do share it, just credit OptionsPlay. Spent a lot of hours on this guy. But we have calls on the left-hand side, puts on the right-hand side, and bullish strategies are going to be at the top. Bearish strategies are at the bottom. We notice when you purchase strategies, our goal is a sharp directional movement. That's very important, especially when we are talking about earnings. Normally, we expect a sharp directional movement of some sort, right? So we are expecting a sharp directional movement. We're positive gamma, which is our acceleration. We're negative theta because as the option expires, it hurts us. That's extrinsic value component, and an increase in implied volatility. So it hasn't already happened. An increase in implied volatility, which is represented by vega, is beneficial for long options. That's why they're positive vega. And then the inverse is true for theta, gamma, and vega on the short side. And I know I'm flying through this because it takes a while to talk through the Greeks, but I'll give you what you need to take away. On the short options, time decay works in our favor. So that's something that we can layer. That's why we layer a short option with a long option. It minimizes the theta, right? Or depending on which way we structure it. And same with gamma and vega. So this should be a good idea. I remember back in math class when you added positive and negatives, this is exactly what it does. So takeaway from all of this is just positive and negative factors that affect your options premium of each individual leg. When we talk about 3 and 4-legged option strategies, even 2-legged strategies, we just extend beyond one. We are combining these together. And the way that you structure it, it really relies on this. So important to know. We're not going to deep dive into it today, but I will give you the components that you need to for each strategy. Any questions on that before we move on? I'll have the chat up for a brief moment. No? Robert, you speak for everyone because we got the no. So does Sean. So here we are. Maybe it's fine. We'll go through it. All right. So let's talk about individually a long put and a long call. If you've ever attended any of my beginner sessions or advanced sessions, any of my sessions where we discuss strategies, the way that I always teach it is with a strategy driver. And a strategy driver can be an individual. For a 2-legged option strategy, it's one of the individual legs. For a 3 or 4-legged, it's normally a 2-legged option strategy that we combine and extend. It's either risk mitigation or you're capping gain potential. That's really all it is. I know that seems oversimplified, but it can be that simple as long as you're discussing it the right way. So a long put, remember delta tells us direction. So positive, bullish, negative, bearish. That's it, right? Whenever we're purchasing options, we want it to move as much at least as what we're buying it for. That is why they are speculative and you expect a sharp directional move because we need to overcome exactly what that is. Now, think about anticipated movements and how options prices are affected. Implied volatility gets amplified when you have a move of some sort occurring because volatility, all it is uncertainty. That goes hand in hand. High beta stocks have higher, it's hand in hand is uncertainty. When that uncertainty is removed, like an earnings announcement, even a Fed announcement, anything that is creating that uncertainty, then it affects the options price. So higher uncertainty means higher implied volatility. Higher implied volatility means higher options premium, which it's all supply and demand. And that means that's what these options buyers or sellers are willing to purchase for that move. And that's why we use it as an implied move. So that's kind of the why behind it. And we'll break it all down. But long puts, meaning if I purchased a put and I was bearish on Netflix, say, I'd need it to move more than what I purchased it for. And a lot of buying could make that higher. A lot of implied volatility makes that higher. A lot of uncertainty makes that premium higher. And then on the long call side, exact same thing, except for I'm bullish rather than bearish. And that's also why gamma is important. Gamma is centered around at the money options. If I'm speculative, I want something that has higher gamma. So when I'm structuring this, I would be looking for a higher gamma because I want it to move a lot, right? Nonetheless, let's keep going. Expect you to know long calls and long puts. But when we put those together, we get the long straddle. Now, this is a base strategy for butterflies, but a long straddle, this is what we use to determine the implied move. Because what you do now is you've created a delta neutral strategy because the long call is positive delta, the long put is negative delta, positive and a negative. In this case, I made it orange. It might have a slight little directional bias, and it normally does because you can't buy something directly at the money. So in this case, this is an at the money option. So XYZ would be at $100. I've amplified the theta because I've purchased more extrinsic value, but I've also amplified gamma acceleration. Think about what happens on earnings. And I've also amplified vega, my exposure to volatility. But at this point, it's probably already high, which we would use other measures to figure out. But that's why you can utilize the long straddle to figure out the implied move. And I'll have some real examples of that. But that's the intent of it because this strategy is profitable as long as it moves more than the combined premium. So if I bought, this is so simplified, the call at 150 and the put at 150 combined, that's $3. as long as it moves up or down by $3, then I'm profitable, especially if you're looking at something with 0 days or 1 day until expiration. And this is at, I don't have an expiration period on here, but you can actually use the implied move at any time, to be honest. You can pull you can look at it since the options expire at the end of the week. I even really love doing it with SPX options. You can do that every day on a daily basis. What's the at the money straddle for SPX options, and that's the implied move. And then you could even pull where the most contracts are and really utilize options for data analytics, this is the first step on that, is which way is the market going to move and what are the options saying for that move. This is the implied move and how we do that. So it doesn't matter if it's volatile or not, but if it is a volatile underlying, then the premium would be a little more inflated. That's all. That means there's a higher implied move. All right. Yeah, we're about to do that actually, Anthony, with the next structure. All right. So Anthony, it's like you let in and you knew what the next slide was. But when we're trading off undefined risk and capping risk, that's what a long iron butterfly spread is. You can look at this in two different ways, but the base strategy for this is you're trying to reduce your move. And I knew I'd find a typo there. This needs to be $2.50 instead of $3. I apologize. But what we're doing here is you are capping your gains on either side. So if I'm selling an 85 and I'm selling a 115, you could look at this and say, oh, that's a bull call spread, a 100 to 115. I buy a call. I technically have unlimited gain potential. I cap my risk by saying, okay, I'm going to cap my gains at 115. I bring in some premium. I reduce my overall cost. Same thing here, just inverse direction. I buy a put. I'm capping my gain potential to 85. I'm reducing my overall cost, so 75 cents on each leg. So now my break even was reduced by 50 cents. That's where the typo is here. There should be a 50. These should be 50 cents moved. But that's the intent of the risk versus reward and the trade-off that's there, and why when we talk about buying option strategies, we want to make sure that you can make 3 times more than you spend. And a way to do that is by structure, but it also could be very difficult. And I've personally gotten burned on Nvidia earnings by doing something like this, taking a directional move because of the way theta works. And if you attended those Greek sessions, you'd know, okay, well, theta, gamma, and vega are all centered around at the money options, which means you might have purchased something where it's at 100, and now that the stock is at 115, this is going to have the higher extrinsic value component, and you have to buy this one back. So that sometimes you have to piece yourself out of those, and we'll talk about that as well, because those are real life scenarios that certainly do happen, and that's why it's important to know, especially when you're trading earnings, how an option reacts to changes in the underlying and changes in implied volatility. Very important. All right, so this is just a way that you cap the wings. Again, keep that delta neutral strategy. Long straddle, this is almost identical. The difference is instead of having the same strike price on the options that we're purchasing, we just move them out a little bit. Very important, your call has to be higher than your put when structuring this. If it's not, then you have 2 different strategies. But here, you're just reducing your cost because it's further away from the money. So hopefully there's something happening there. But yes, these are long options. Long options are defined risk because when we own the option, we own the right to execute upon the terms. We don't have to do it if we don't want to. Therefore, the risk is defined. So net long is defined. A way to cap it would be to mitigate. There might be a reason to cap it, which is you're going to have a high extrinsic value component, and we want to mitigate the cost of that. That's why we utilize bull call spreads constantly. But when you do that, you have that risk of it going too far, and then it's going to cost you a little bit more to buy back your short option. But yes, it gets amplified, and I've got some examples of that. So real quick, I know we're running through these, but that way I just want to make sure you know these strategies really well before we go through real examples. So short put and a short call, we're going to combine these to show you just a short straddle and a short strangle. These, it's the opposite. That's why we show the T chart. You can literally use it as a mirror. So if your long options are defined risk, your short options are not. It's the short call individually has unlimited risk potential. So we've got the deltas, positive theta, negative gamma, and negative vega. So these are the things that we can mitigate. We can utilize these to draw down the cost of our super high premium due to implied volatility being heightened around earnings. These are neutral strategies. They're neutral to a slight directional bias. I cannot stand it when someone says a short put is bullish because it's not. It is neutral to bullish. You just need the stock to stay exactly where it is or move ever so slightly. And honestly, if it moves more than your premium, then you could have done a lot better being speculative and having another trade. So important to note there, that's why you don't want it to go to a very specific, you want it to go to a specific price and you have a very specific price target there. And you don't want it to go any higher than that. All right, so short options, we just want the option to stay exactly where it is, which then should give you the logic when we have a short straddle, because when we put those together, you're pinpointing and it's really a time decay component. And you need the underlying security to stay exactly at the strike prices that you chose. So we're selling to a one call, one put at the same strike price. So that's a short straddle. Straddle is literally the V, strangle is a put your hand on strangle. That's how I was taught it and how I remember it. Here, it's just your danger zone is if it moves more than the credit that you received. And losses, of course, can be substantial if it moves down too far, and losses can be unlimited if it moves up too high. But you still technically have a neutral strategy because you need it to stay exactly where it is. And theta benefits you, but sharp movements are not good. An increase in implied volatility is going to increase, even if all else equal, an increase in implied volatility will cause this strategy to become unprofitable, even if it stays exactly where you need it to be. So, but that's should give you a trigger. Oh, okay, well, maybe I should sell this when implied volatility is high and I expect it to come down, which is what happens around earnings. All right. And a short strangle, much like the short straddle, the difference here is now we're, instead of defining an exact pinpoint, we're defining a range. And so this is what we'll focus on. I'm saying, excuse me, that I feel like the underlying is going to not go higher than 103. So, and no lower than 97. It's going to stay in between that range from 97 to 103. And if it moves more than the premium that I received, I'll be okay. I'll break even. I'll break even if it moves that exact amount. If it moves more, then the same thing occurs. Substantial losses can occur to the downside, and then unlimited to the upside, which is a risk if you think about earnings because they do make drastic moves, but implied volatility does contract. So we need to structure that, and that's why condors really come into play, which is what we'll bring in next. So condors, sometimes I describe these in different ways. Condors, just like the butterflies, you just add the wings to mitigate your risk. If I have unlimited loss potential to the upside, I'm going to cap my risk. If I have substantial loss to the downside, I'm going to cap my risk. So you're just buying further out of the money options on either end. Another way to describe that is a bull put spread combined with a bear put spread. So I need it to go up above 100 on a bull put spread for this to be profitable. If it does fall and go move adversely, I cap my losses when it goes to 90. So that's a way that we mitigate our losses. And then on the call side, as long as we want it to go below 110 in this case, but if it does increase past 120, I'm capped. I don't have unlimited loss potential because there is an obligation to buy and sell in here. And what you're doing is you're giving yourself a right to buy and sell, and that's why they offset each other. And it's a way to increase premium as well, mitigate risk. And that's the way you combined all of the Greeks together to amplify and mitigate risk. So amplify the good, mitigate the bad. And together, that creates an iron condor. So we defined a range. We need the security to stay between 100 and 110. If we're wrong and it moves too far, we've capped our loss potential, or we're wrong and it moves too low, again, we've capped our loss potential. That's the give. The take is we reduced our premium that we received by $3. And also another way that I learned this personally, when you're thinking about what's driving the strategy, what's driving a short iron condor is a short strangle, the short call and the short put. Also, the driver of the strategy is always the most expensive option. So if you pull up something together on your trade ticket, on whatever platform you're using, even on OptionsPlay, but at your broker, and you look at the most expensive leg, that's your driver. It's very simple, or can be. All right, so let's talk about trading iron condors and what we're going to do. So normally, we would want something that we don't have a directional bias to. If we have a directional bias, there's something else we can do. Because if we have a directional bias, it's going to move in another direction. So we are expecting a range bound. We're going to select a range for a security. So sometimes a lower beta would be better. Otherwise, other strategies would be more suiting. There is no additional margin requirements. The way it works with a short iron condor is it just takes the margin requirement of 1 because it can only go up or down. It can't go both. So you don't have 2 spread requirements. You only have 1. And this is good for strong support and resistance zones. So it can be good to do even in a sideways market, but we're going to use an implied move on earnings with an amplified implied volatility that we know is going to contract because that's what options do post earnings. And so capitalize on that and then structure accordingly with the positive and negative factors. All right, so we're going to go through those earnings plays, but that was section 2. And now we're going to talk about actually putting it together. So any questions so far? Because I know we're going to go. I'm going very quick. Sorry, 4:40. Nope. Okay. So we're going to talk about when to use strategies. So that's good. And then we're going to look at some examples. So I think that's okay. All right. And we're talking about expirations. All right. I think that will cover all of those actually. So that is great. Okay. So when we are trying to understand the implied move, I literally did this 5 minutes before we started this. This is where Netflix closed today. I pulled the at the money call, so the closest option, the put in the call, and we've got an at the money straddle. And when you want to plot the implied move, we're trying to see we want to take out the time component. So the way that we take out the time component is we choose the nearest expiration. That's why I say it's good to do with SPX options because there's some that expire every single day, whereas with some equities, that's not the case. So we've got 1 day until expiration tomorrow. We looked at it at the end of the day. So I'd say we got time basically taken out of it. We look at the price of it. Remember, there will be a slight directional bias in this one. It is to the downside, which is actually odd looking at this. I was expecting to see that to the upside being more expensive because the call is technically in the money by $1.49. So that is interesting. So what we do though is remember, we want it to move in either direction in order to be profitable. This expires in 1 day and is very expensive. And that's because of implied volatility. So combined, that gives us about $52. You take that amount and divide it by the last price, and that gives you your implied move. That's where it comes from. Now, yes, the implied move on earnings is 8.5% because options traders are willing to pay combined $52 about. So that is the move that's expected. Now, there are some platforms that want to account for that theta decay aspect. So if there is a little more time, you would take the $52 and find 85% of that number and then do the next math. So meaning if you have a strategy where you're trying to say what is it, an underlying security where you're trying to say what is the options telling me how far up or down that this will move, you would do 85% if you've got maybe a week left until expiration, because you need to get rid of that theta component, right? As in the time. Theta includes extrinsic value. You need to get rid of the time part, not full extrinsic. We're not putting in a strategy right now. We're just understanding, and we're using options as a move, because what will happen, and we'll check, this is where we'll have to check this tomorrow. So take a screenshot of this or write it down. Where does Netflix move tomorrow? Is it going to move 8.5%, and which direction? Because normally what will happen is, now that we're getting, these are going to be 0 days until expiration, this probably wouldn't have made any money unless there's something crazy that happened on the conference call that was just astronomically and out of our mind. That is called a volatility crush. And I've got some examples. So this is the one that we're just going to monitor. Next time we do this presentation 3 months from now, I'll have another example of what happened afterwards, but I've been slowly adding to this one. So this is just understanding, and that's it. We're not placing this trade because we would get killed by volatility. All right, so it's expecting an 8.5% move. The intent of this is understand how to plot the implied move. So I think we got there. So let's go to the next one. So Nvidia, here's an example of, and I believe this one was, might have been right before last, but it was either last quarter or the one before. We could check prices. Nonetheless, this was right before earnings. We had 2 days until expiration. So here is an example of the implied move. We had 675, 37, and 37. And so that's about what, $80. Moved more than that. It's Nvidia, doesn't surprise me, but that gives you an insight to the implied move post earnings and how this would not have been profitable. But it did tell us a move that we could expect. In this case, it was about $80, and it did move way more than that. So there's another example. So I had it there, 11% move, and it moved 16% in this case. All right, now this one I'm gonna show a trade that would put together, and this is an older one, but I like to have, like, again, the past, what would have happened. So Tesla, right before earnings, the nearest expiration was 2 days until expiration. Same thing here. We're going to choose a call and put with the nearest expiration and the nearest strike so an at-the-money strike that we could find. They're roughly $10 each. That's an implied move of 9%, $20.04. The way that we would structure this, now this is I like to call this the Tom Sosnoff trade, because this is the way he does it, is he would structure the move and define the range. So remember when I said if we're trading iron condors, we are expecting a range. So Nvidia moved out of our range. Let's see what this one did. So our range is $20 up and $20 down from the current price. So $20 up would be our 242 call. That's as high as we want it to be. We don't want it to go any higher. And then $20 down would be 202.5. I think there's a split or something because those were available. Normally you don't find options with 50 cents or cent increments. This is the range that we've defined. And then we added wings. So something that is a little lower, just in case we are wrong and mitigate our losses. And this one is a little higher in case we're wrong and we mitigate our losses if it moves too high. Because remember, a short call, has unlimited risk potential. And it also is very capital intensive, meaning there's a larger margin requirement. So we want it to stay in between 242 and 202. We've made our range. Together, we're getting a credit of about $2.50, $2.49 total. What happened post earnings, this one was really close. I don't remember, must have missed, but sometimes they beat and they still go down. So this is what happened afterwards. Without knowing what happened in this case, it moved 9.06%. So that was really close to the implied move. This one did a good job showing what the actual move was. So we were able to close that at a 96-cent debit. It's a small gain, but it's a winning trade. And trade small, trade often is the way that we look at options because of the decaying factor that is there with them. But this is a good example of how we utilized a strategy that defines a range. You could not buy the outer wings, but you would then, at that case, have much bigger risk potential and also much larger margin requirements. So this is what I like to call the Tom Sosnoff trade, because he is notoriously will plot earnings on a short strangle. I've just added the long legs and made it a short iron condor due to the risk that's associated with a short strangle. A short strangle has a short call, and a short call has unlimited risk potential. But yes, I am talking to this in the context of earnings, as in I'm plotting the implied move and I'm choosing my strike prices based on the implied move. So the implied move was 9%. So $20, which is $20 divided by that, $20 higher gives me my call price, $20 lower gives me my put price. And since it went to 202, it stayed in the range that we needed it to be. And remember how I said earlier that things can move depending if you're taking a directional play and extrinsic value is centered around at the money options. Well, the option in these strategies that we have together, these individual legs that is closest to the money is this put and is also the highest value. So that should make some logic and clicks happen right there with actual pricing. All right. And I've got another one for you. Oh, I thought I did. Take that back. I had one I thought on Apple, but nonetheless. Okay. So when you're trading short iron condors, they're good for range bound markets. And when you want to sell an option, you want it to have high implied volatility. And you expect implied volatility to decrease. So if you ever hear Tony or myself place a trade or talk about a trade idea and we say options are cheap or options are expensive, we're talking about normally implied volatility rank or implied volatility percentile. And that's what we're looking at to determine if it's cheap or expensive. And I'll show you where to find that on OptionsPlay. So that's step number one whenever I am trying to decide what strategy I'm going to do. Short iron condors specifically, we talk to them in the sense of earnings because those generally have high implied volatility already. However, this is a good strategy that's deployed in a range bound situation. We defined a range by an implied move, but if the market is range bound or a security is stuck in a range, then this is absolutely an effective trade that you could do because this is profitable as long as the stock stays in that range. As long as the underlying position stays in that range, then this would be a profitable trade. So this is the way that you'd set it up, your view. Normally, whenever we sell options, we look at 30 to 45 days until expiration. That allows you to also have that theta decay component. So we don't, unless we're doing binary events, you can certainly adjust that, meaning you can have a shorter expiration where you're doing something based on earnings. Earnings happened, no reason to be in the trade anymore. And then closing out, we just have some best rules of practice. And this is if we're doing the 30 to 45, 14 to 21 days until expiration is normally when that theta decay kicks in. That's when you want to close it out. And we want to take profit when we make 75%, take our loss when we lose 100% of premium in the short options scenarios. All right, that's old screen. Let's get that off. All right, so I'm going to bring up OptionsPlay because I have some examples of directional plays with Netflix that we can talk about as well. So I want to make sure that we discuss that, and I have the implied move up as well. So that way I can show you the speculative view. But that was the range bound short iron condor, very common way to trade earnings from the probabilistic perspective that you can utilize options for. So give me a moment to do that. And while you do that, if you want to pop your questions in the Q&A, that would certainly be helpful. All right, here we go. Let me find the chat window again. Okay, so here I have Netflix pulled up, and I've got a couple of different examples. So our best practices when we're purchasing options, so now we're flipping it around a little bit. Well, first and foremost, let me start with the short straddle. So here I've got the cost. So this is where this came from, the 25 and the 26. So about $50 that it's expected to move. That's where this came on, $51.98. We could pull that right there. That is the anticipated movement and the way that we can utilize this tool just to figure out the implied move. That was step number one. If I wanted to take a directional view, and mind you, I didn't, this isn't a trade I actually placed. I just chose this because Netflix was reporting today, and we're just doing this from an analysis and understanding perspective. Buying a call because implied volatility is generally high. It's not showing high here. It's 13 out of 100. So that would say that it's cheap. Normally, when we're looking at higher implied volatility, we'll look at an IV rank here. Anything over 50 is higher. But it's costing me $4,000 for 60 days. Because whenever we're purchasing options, we usually do 60 days because we're buying time. We also want to sell time. That's where that's coming from. So that's a best practice there. And our break even 655, but that's at expiration. So know that. The long call butterfly, let me show you the structure of this. So basically, the intent of a butterfly is we're taking a directional view. So in this case, speculating bullish, and you want to lower the cost of this as much as possible. And the way I saw a question in there on how I choose my strike prices. So OptionsPlay will automatically choose the best short and long based on the back testing that's there. So it's going to start with about 60 days. And then remember, you want to account for some capital appreciation. So it chose 715 altogether. The way that you structure a long call butterfly is, remember the strategy driver. The strategy driver is the long call. So it has unlimited gain potential. What I'm doing is I'm capping it at the short strike, which is 715, but I'm doubling up on it. So I have two. And when I have two, I've now created a short call that has unlimited loss potential. Notice that theme throughout, in order, which would have a higher margin requirement and is a lot more risk. So in order to mitigate that risk, I'm buying a further out of the money option. And that's what makes it a broken wing, because it's not equidistant between the legs that I'm buying on either side. And the reason for that is, if it was equidistant, then if it did move too high, it'd end up in a loss. So this makes me, if I am bullish, and I'd be in a profitable situation no matter how high it would go, is the intent of it. So this is the way that you'd structure a long haul butterfly. And this is the way I would personally trade earnings. Again, I didn't look at Netflix to place a trade or analyze it. This was just something that pulled up. I wanted to make sure I give you that speculative view and how to pull that together. And I know I ran through that very quickly, but all right. So let's go through some questions, and I can also give you some examples as well. So Mike would never do a 45 days till expiration on earnings play. Way too risky and slow theta compared to weeklies. Right. So we want to make sure we say 60 because theta decay is not linear, and it accelerates 14 till 21 days until expiration. So 60 days until expiration, normally when you're buying. I will say, if it's more of a binary event like earnings, that's the exception to the rule, where you could do 30 days or even less is really the scenario. When do you do credit spreads? Credit spreads are, so whenever I'm deciding if I'm going to go short or long, my first line of defense is, where do I think the stock is going to go? Am I very bullish, or am I neutral to bullish? Or am I very bearish, or am I neutral to bearish? And that will give me my indication. That's my first line of defense. Credit spreads come in when you are neutral with a slight directional bias. And probabilistically, you tend to have a higher run weight with those, depending on how you structure everything together. So because you don't need it to move as much. So it really depends on your perspective. That's the first line of defense. Second line of defense would be, is implied volatility high or not? And if it is high, then and I did chose I was going to purchase, I may switch to selling at that point in time. So me coming into Netflix, if I was taking a directional view and I see that IV rank is 13, I might have just done a bull call spread because I knew that it was considered cheap on terms of options. So that's the way that I would think about choosing being long or short. And when I say long or short, that a long means buying a call or a debit spread. Short means I am selling a call or a put, or I am selling a credit spread. So those are what that terminology translates to. Samir asks a good question. Isn't earnings the wrong time to do a short iron condor since it will move either up or down and you can lose money in either way? That's why we cap it and you choose a range, and why I pulled up those examples earlier of what actually happened. So since we plotted that move of Netflix, even though it's already reported, when earnings, and remember, options, we cannot trade after hours. So once they report, there's other things that can happen that affect the underlying security, which is the conference call. And then there could be other macro events. We have lots of uncertainty right now. So I have to pay attention to that. So it is the reason why it can be a good time is because of that heightened implied volatility that is normally there and that volatility crush. So tomorrow, even though this is 13, I expect to see that to go much lower because of the volatility crush. So that is the reason why one would do a short iron condor. But what you do is you choose a range based on the implied move, and that is very wide in comparison to what you would normally do. That makes it a little different. You cannot find options prices after hours, but you can do a little calculation. So Delta tells you the dollar amount or the amount that the options premium will change with $1 move of the underlying security. So you could use Delta to get an idea of where the options will be. All right. Go back a little bit. There isn't a place on OptionsPlay to see historical options prices. We do have them stored though in a data feed because we do a lot of back testing. So Sam, if there was a reason for why you want to see that, let us know, and maybe that's something we can discuss on one of our next iterations of the product. But otherwise, no, because when we're looking at what direction or thinking of an underlying security to go, we would chart the stock, not the option. Ramesh said options premium, cheap or expensive. That's right here, the implied volatility rank. And you might also see that on your broker's platform as IV percentile as well. But that's what we're looking at. If you look at purely implied volatility on an options chain, that's not necessarily true. You want to look at implied volatility versus itself. It could have amplified implied volatility all the time because it's a high beta stock, like Nvidia or Tesla. Carl, about cap it. So I mean capping my risk as in stopping my risk at a certain price point. So if I buy this 615 call or this if I have a 610 call here, I'm selling the 715. That's capping or stopping my gain potential in this case. So that is reducing my overall cost of the long option by the premium that I receive, which is $10.35. That's what I mean by capping. And that's the way that you utilize options combined together. So with the short option, it would mitigate my risk. With a long option, it caps or stops my gain potential. So it stops gains or it stops risk. Thank you for asking for clarification there. Anthony, what criteria do you decide versus naked or a capped trade. I personally don't trade naked options just because I don't want to take that type of risk. And you can buy a further out of the money option just to mitigate it, frees up capital. So many reasons. I don't think there's ever a reason to have naked options in your account. And that might be because I've worked in here so long and I've seen a lot of accounts that were in the millions of dollars end up going negative because of one trade that just went so adversely. And so I don't like that risk potential. Again, might be biased there. Samir, do you play the short iron condor on every earnings event, or is there a criteria to select certain stocks? The criteria is range bound. That's it. Because that's when it's profitable, is if it stays in between two price points. So it has to go no lower than your short put that you selected, no higher than the short call that you selected. And so if something is range bound, that's a great strategy or a great underlying security to choose a condor on. How do you get the strategy drop down? So you can click on anything on default and go to modify, and then the strategy drop down is here. And then we've got so many you can choose from. But by selecting modify, you can do that. And if you want to watch these instead of hitting trade, you can just add it to your portfolio as well. And that's a great learning mechanism. We get asked a lot, do you have paper trading? And it's yes, through your portfolio there. You can make a mock portfolio. Tom uses Delta to choose strike options. Can you provide your thoughts on that? Absolutely. We use Delta as well. Delta is so many uses. Delta, especially on the short option side. So Tom is very much into a probability and he's an options seller. Learned a lot from him. Really look up to that guy. But yes, and if you think about the way Delta works as well, we always say Delta is on a scale from -1 to +1 and 0 represents a neutral strategy. +1 or -1 is your destination. And options that are further out of the money will have a delta closer to 0. So if you're thinking in terms of covered call or choosing that strike price that you want to cap your gain potential, then you tend to use a 0.15 or a 0.2 delta for that reason, because it has a lower probability of being in the money. But yes. Tesla has earnings next week. That is something we could look at. Sure. Do we have probability of profit? Yep, that's here too. You can just click on this and that's all right here. Your probability of profit. So we get asked that a lot, is how do I toggle between the screens? You just click on it. So I'll give you your score and your trade costs just to compare. And then if you click on it, it gives everything together. And the intent behind that is this is the calculation used for the score. So either A, you look at the score, or B, you look at your cost, your reward, and the probability of profit break even. That's what happens there. But yeah, if we were looking at Tesla, wanted to look at an implied move, the way that OptionsPlay is set up, it should give us our earnings date, which is April 23rd. So the way I'd get there is implied volatility, because that's going to give me a straddle. I'm going to modify it. I'll just change it to buy to the mid. And this is already at the money. And I'm going to find the closest expiration inclusive of earnings. So we can't use tomorrow, but we would use the this is where I would apply that 85. So it's about $14.35 because every contract represents 100. Now I've got a calculator out. So give me one moment and we'll get the move. But if it's 14.35, and then we would divide that by 149.9. Oh, I was doing that. Hold on, give me a second. 14.35 times 0.85. So when you use 85%, that's $12.19. I'll take $12.19 and divide that by 149.93, and I'll get about an 8.1% move. So an 8% move is what I would be seeing for Tesla. And if you want to take a bearish view, thinking about an 8% move, then I'd click on the bearish button. start with buying a put and then look at a put vertical, which is a debit spread, and then we could adjust from there. But here is where you could even say where you think the stock's going to go. So I should have really written down all this math, would have been made it easier. I'm going to find out 8% one more time. Times 0.08 is about $12. So you said you're bearish. So 149.93 minus 12 gives us a price target of 137.93. So I would put that in 137.93 of where you think it's going to be. And then this will give us our indication of profit and loss. And that's how I would utilize the implied move to help figure out which directional trade I'm going to take. So in this case, buying a call at 150 may not be a good idea, but then I could adjust and modify probably my expiration date here and adjust. So hopefully that helped with your Tesla. But yeah, the IV rank does seem very low. I'm going to check on that calculation because I also thought that was quite low for Netflix as well. All right. So we have hit 508, which means my 13-year-old son is going to be home any moment, in which case I'm going to switch to 7th grade math homework. So exciting. So I don't think we have too many questions there. Awesome. All right. Well, thank you guys for attending today's session. Next week, I believe we're going to bring it back to basics and talk about covered calls, but I'll probably bring up Netflix just to see what happened and we can discuss that as well. But yes, this is recorded. As long as you are an OptionsPlay member, you will get a copy of this into your email. And you'll also get a copy of the slides. And normally we have posted them back on YouTube. So you should see that normally Sunday or Monday night as well. Awesome. Well, I hope everyone has a wonderful evening and I will talk to you next week.